$250,000 richer, $500,000 richer. Or are you? More than 7 out of 10 Colorado homeowners are far past their capital gains tax threshold, and many don't even know what it means for them when they sell. Hey everybody, it is Alyson, your real estate strategist and realtor for the South Denver area. Let's talk about this capital gains tax trap. It is one of the biggest financial pitfalls that I see for long-time homeowners, landlords, investors. Now, having that large gain is a win, but the real opportunity comes when you know how to leverage all of that equity to your advantage and legally minimize the taxes that you pay to the government when you sell. Now, that may come with an easy button here soon because President Trump has announced he wants to eliminate the capital gains tax. But until we see legislation passed, we are still working under the current method, which means we're all paying up on our primary residence if we have enough gains, and on any investment properties, all of the gain is taxable. So let's talk about the strategies of how we can keep our wealth in our pocket and legally not have to pay the government any or so much of the tax that they want to get their hands on. So what does the government identify as gain? It's not just your purchase price and then what you sold it for. They factor in things like closing costs, qualified improvements. Not every improvement counts, but qualified ones, and everything with a receipt. So please keep receipts. And while the rules have changed over the years, right now, a single person can deduct $250,000 on capital gain from a primary residence. A married couple, $500,000 off a primary residence. Once it is not your primary residence, an investment of any kind, we're not talking just rental properties. There are other investments, but an investment of any kind, a second home, your vacation home, you have 3 homes, anything where it's not your primary residence. If you've made money on it when you sell it after you've accounted for the other costs, improvements, etc., you have some gain, and the government wants their share. Sometimes paying out the tax, taking all that money and walking away is the way to go. But those taxes can add up, and sometimes it's not the way to go. Often that federal tax rate is coming in at 15 to 20%. You've got to tack on your state tax rate on top of that. If it is an investment property, there's often depreciation recapture, which is a separate thing to account for inside of there. And if you are going to make a windfall that year by selling that property, or you have other income that you bring in and you hit a certain threshold, you're also going to be paying the 3.8% in that Medicare tax on top of that. It can add up quickly. There are states where it's 30+% in capital gains tax alone. Now, Denver is not a California market like San Francisco, where people who bought 15 years ago, 20 years ago have seen sometimes 10x, maybe more, depending on what they got and when they got it. But we are a market that has seen strong appreciation. Look at this data. So I pulled Denver-wide data, then I pulled South Denver data looking at just Douglas County. It was an easy snapshot to pull. Then I pulled just one of our suburbs. I pulled Castle Pines, and we're looking all the way back to 2009. So if we are taking at what point in time it took for a single buyer to recuperate their $250,000 in gain just based on average home price differential, you can see here we're looking at 2018 to 2021. We've gained $250,000 depending on which market that we're in. So somebody who has done improvements, has purchased something that was a great deal in this time before COVID really hit, or refinanced or put a large amount down and then did some additional work. Whatever different scenario we could be in, it's entirely possible that a single buyer has already, just in the last 5 to 7, 8 years, far surpassed their $250,000 121 exemption. If we look at that $500,000 threshold for a married couple, it does take us back a lot farther. Remember, these are average numbers though, so it's not accounting for a spectacular house, something on open space, a larger lot in an average neighborhood, mountain views, new construction, essentially all the things people are willing to pay premiums for. So if we're just talking about average houses, but when we look at that $500,000 differential, For the just Denver area, we have to go back a little older than this data. So we're going to just before the 2009 mark into late 2008. For what we're seeing in the Douglas County area, just before that also, so pre-2009, but we had a dip in the market, so you could have bought for a whole year there. Summer 2009 to summer 2010 also would have gotten you on average to where you are at or surpassing your $500,000 threshold. And then Castle Pines, totally different story. That place has had a boom. There's been development, there's been growth. It's a luxury market. It sits north of Castle Rock. It's just a little bit more set away. It's an executive community. 2013. So if you bought before that, you have really established yourself in a way where it might be time to get a little strategic about how you don't have to hand over some of that to the IRS if you're going to sell. Now, these are just snapshots of areas, and this is why the data supports that more than 7 out of 10 Colorado homeowners are already past their threshold of either $250,000 or $500,000. And then you mix in that we have investors who purchased a long time ago. They've been holding properties for a very long time. Some of them have been rolling in, selling one, rolling into a new one, and that one they got with cash, and it's appreciated so much that if they go to cash out of their investment properties because they no longer want to be a landlord, that capital gains tax assessment on them and the depreciation recapture, which rolls from property to property to property, can really add up and eat into the wealth that they have built. Are you one of those? Do you know one of those? Are you wanting to say, I don't really want rental properties anymore? Maybe you don't want them here. Maybe you had some in California. You moved them here as California became more tenant friendly, and now we're becoming more tenant friendly. And you're like, I don't really know. But the thing is, you don't have to just keep rolling them into properties. There are strategies for both primary homeowners who don't want to pay the tax and for investors who don't want to pay the tax but want to be burden free. There are over a dozen legal ways to minimize how you pay out the IRS what they come knocking for, but there are more common ones. We often see, of course, the 121 exemption. We see 1031 exchanges. We see DSTs. We see REITs. The leverage of the step-up cost basis at death. And more than anything else, the way to really leverage the value of these is to combine them, to leverage them together. My team has seen a family where they thought they were going to net a full $700,000 off of a property. They had plans for every penny of that. Often there comes a point, especially when there is, long-time ownership of a property or investment properties that need to be sold off, where it could be a care situation, a last house situation, where we're thinking, kind of what's this last few chapters of life? And that can be costly. It can be expensive. Even if there are investment factors going on, you've got all sorts of other money coming in, but you don't want to touch it, or you have a plan for what you're going to leave the kids. That money, that $700,000 was planned for, but what had been forgotten was what was going to be owed. $150,000 was planned once it was calculated to have to go out to the IRS. But there were ways to get around that. It just takes strategy and it takes time. The hard part for us is when we see these tax hits come right when our folks are trying to simplify life the most. We hate seeing these tax hits derail or shift or bring stress to a plan for retirement, a plan to bless someone in the family, a plan to support someone who needs it when a shock came up, something else where that money is really needed. And just because it went to the back of the mind, or someone hadn't coached the client through the plan, or another agent came in and just wanted to sell the house and never walked them through all of the financial pieces of the puzzle and how to maximize their asset, and the check gets written. We've had CPAs tell clients, just at the end of the year, you have to write this check, and they never knew. They never knew there was a way around it. They didn't have someone coach them. And that part is just really disappointing. Taking these legal strategies to minimize what you owe the IRS, to then turn around and let you bless your family, bless your process of what comes next for you. Take that money and put it toward continuing care. If someone didn't have long-term life insurance, this now becomes a huge component of that. I've had folks who thought, well, I've got 3 investment properties and 3 kids. I'm just going to dole out a property to each kid. That's going to be my legacy. And I'm not really worried about XYZ. I'm going to sell the house, take all that money and go into this continuing care facility. I have it all checked off. Then they learn that each kid didn't necessarily want a property, but one property was worth more and it made one kid jealous of the next one. And all of a sudden there was turmoil around that real estate. And then when they were going to sell off the single family home they'd lived in for years and raised their kids in, it had appreciated so much there were taxes and it didn't fulfill the financial need they had for long-term care. I mean, right? The dominoes and dynamics. And so a different plan had to be created, but there was one that streamlined everything and got them financially where they needed. It left the kids feeling at peace and loved and happy and equal, which is a really important piece that sometimes parents forget, is how do you make the kids feel on equal footing so the love feels equal when you are gone, and it's not always just tossing a property at each one of them. And so leveraging all of these different legal ways of minimizing taxes also can be used to your advantage to protect your legacy, bless your family, and increase the wealth and assets that you've been banking on mentally, and just be able to write off that, check that never needed to get written anyway. So it's one of the strategies and things I love to do and help people do. It's the strategist part when I say I'm a real estate strategist. So if you fall in this boat or know someone who does and you want to connect on this, please reach out. I would absolutely be thrilled to talk through how we can avoid writing a check to the IRS legally. And I will see y'all next week.